right, hi, good evening, everybody. Welcome back to another session. So yesterday I skipped a class because I wanted you guys to practice entries. All right, and I went back to. I wanted you guys to practice entries at least to a good extent before I start starting at specific points, which is before we move into synthetics. As a matter of fact, on the outline. But then I've been able to, I instructed you guys that you can start using your position tools and all of that, and you can start dropping your trade ideas, the ones that plays out and the one that doesn't. And then I was looking through the group, basically the losing trades group in particular, and then the questions group too. I think I've been able to answer the question from our previous session up to today. And then for the losing trades group, there's something I noticed is the fact that some of you have not mastered this type A, type B's demand and supply zones properly, right? I think it's a different thing to understand or or to be able to get it when I explain it and to be able to replicate it on the chart. They're two different things, and that is why I always emphasize on studying. When we did, the very reason why I introduced the concept of demand and supply before entries is majorly so that when we get to entries and I'm talking about all these things is not strange to you, right? And even when we did demand and supply, we're giving assignments, then I would ask you guys to drop your demand and supply zones and your validations and all of that. And most of you were able to do it rightly. That is what I expect you still do now that we've gotten to entries. The only major difference now is the fact that the sweep is now being introduced as a must. If not, this demand and in fact these levels you're buying from your type A and your type B entries, they are still demand and supply zones, whether you like it or not. Right? Just that these demand and supply zones now sweep what highs and lows to become protected. Okay, so what I want you guys to do basically for most of them on the losing trades is to go to the way, like the most important thing. Sorry, give me a minute. The most important thing when it gets to these entries is the fact that the entries are schematic in the sense that like they have a model that you can use to check if what you're doing is right or wrong. When you're done mapping out your entries, go to that particular setup that you've mapped out and check if it aligns with something like this. Try to map it out. There are times I just go to my charts. Like, let me look for a very good example. Okay, let's see what price did on this zone. All right, let's see what happened here. Now, on this particular level, if you look at this now, I can easily see that, okay, there was a sweep. Even if not that sweep, there was a sweep of this particular low here now, right? And then there was a sweep here. And after price swept, what did it do? It went straight up to create this break of structure. So here now I have what a break of structure. I'm pulled back into 50% to create what this level of inducement and then this break of structure, right? And then I can now clearly map out this zone as well, my area of demand. Now, if you look at something like this, now this is a setup that I just like recognize on this particular pair, right? Now, if you look at something like this, I can easily map out my type A entry from this. And that is what I want most of you to do. Stan, can you please confirm that my Telegram, they can see my Telegram screen?
Yeah.
I don't know if, okay, my Telegram is sharing, right? I don't know if the setting is going to protect it. All right. Now, if you look at something that like this
the winning
one,
trades are not showing.
oh,
Let me
okay.
stay on it. Let me do the settings. Stay on it.
All right, please just do that. I want to emphasize on something. Well, while he's doing that, Stan, please let me know when you're done.
Okay.
Somebody asked me to talk about risk to reward ratio. I think I saw that on the group earlier today. Now, when people say 1:5 RR, 1:3 RR, 1:2 RR, that RR in question means risk to reward ratio in actual sense is usually RRR, right? But I think this period people just call it like RR, which is risk to reward. But then the full thing is what RRR, which is risk to reward ratio. Risk to reward ratio is just like the ratio of your risk to your reward. When you see people say, okay, 1:5 RR, it means that they are risking what 1 to get X5, which means that if you to get 5, sorry, which means that if you're risking $100 on a setup, risking $100 on a setup means that, let me say, at stop loss you want to lose $100, and the trade is a 1:5 RR trade. It means that at take profit you're getting what 5 times 100, which is what at take profit you're getting what $500. If it's a 1:3 RR setup and you're risking $10, it means that at take profit you're getting what 3 times your risk, which is what $30. So the first R is risk, the second R is what reward. So it's like the ratio of your risk to your reward. So if you have 1:4 RR, it means that if you're risking $1 at take profit, you're making what 4 times that $1, which is what $4. And then if you have 1:7 RR, it means that at take profits you're going to be making what, let me say, if you're risking $100 now on a 1:7 RR setup, it means that stop loss you're losing what $100, but at take profit you're making what 7 times of that $100, which in this case is what $700. All right. So I just realized that if the settings from the class is changed, some people are going to get access to download most of the materials, which is a bit risky. But then here's what I want you guys to do. If you go through the winning trades, most especially because I went through all of the subtopics today to see what's going on there. Now, if you go through the winning trades, most especially, you would realize that you're able to recognize most of the patterns that your mates are using. Like if you see this British pound CAD, that GBP CAD, I don't know who this person is, you can realize that just looking at the setup, I know that the first setup was what a type B setup, a type A setup, sorry, and the volatility 25S is what a type A setup as well. If you decide to look at this person, okay, this did not show. This is what a type A setup. Like if you look at what your mates are doing, you're able to recognize that okay, what you're doing is what a type A, a type B. But then there are some setups I see on the trade idea groups, and I cannot even tell like what you're doing at all. So what I want you guys to do is that when you go to the chart and you make an analysis, it doesn't even have to be a backtest. There are a lot of backtesting examples. If you go to the chart, you see a lot of backtesting examples. I told you that instead you can decide to what forward test. That is why you have the trade idea group. Right? You go to the current price action and start looking out for this model before they play out. Because definitely you're not going to be what except you're trying to master the models, then the back testing is what very important and very good to try to recognize them, how they play out, what's their win rate and all of that to get your own assurance. But when it comes to actual testing this out to know if you're ready to start executing with free money, you have to do it in a forward testing way. And it's not by just mapping out anything on the chart and sending to the group. There are a lot of things that I see on the group that I'm definitely not comfortable with. A whole lot of it, right? A whole lot of it. Whether you're mapping out with claim blocks, I already taught you guys how to map. I think I saw something on the claim blocks, especially. I don't know who that person is. Maybe after the class, I'll try to send you a message. Probably you have some reasons why you sent that to the trade idea group. I'd like to find out, right? But then here's what I want to talk about. I told you guys about the reclaim block. I told you that do you see this particular type of order block now in a supply setting? This type of order block is an invalid order block. One, there's no inducement, right? Something like this, if you want to sell from this level, there's no inducement. It's neither your type A nor is it what your type B type of entry model, right? But I told you that order blocks like this, if you want to trade them, like if you want to trade their failure as a reclaim block, when price takes them out, it means that you must emphasis on must see what a type of liquidity before them, which means that this is how you're going to what, trade them after price has taken them out like this, right? After price has, sorry, this is okay. After price has what, taking out that invalid order block, which is another block that did not meet your validations for what another block should look like, price needs to give you what a form of liquidity or a form of inducement before you take it, which means that you're not setting straight up entry like this when another block is caused by an invalid reclaim block. Instead, you're waiting for what? You're waiting for a form of inducement before you now anticipate that what? Before you anticipate that price comes, mitigates, and what? Sells to the downside. Something just like this, but you need an inducement when it is formed by an invalid reclaim block. I'm emphasizing on this one because I still saw someone ask if this is valid to buy from. And then I was looking for the inducement. This inducement is very important in cases like this because when you take buys from levels like this, most likely you won't have like a very good win rate or let me say sustainable win rate. Do you understand? Invalid order blocks that creates reclaim blocks need what's inducement before them. Let me see if I can see something on the chart. Okay, let's look at this one now. We had price coming in a downtrend like this now. First of all, this is what this is another block, right? And then price puts in this low, puts in this high, puts in this low, right? And then can you see that this particular inducement level was what was taken out? This particular inducement level was taken out. Sorry, this particular order block at this level was taken out, right? And what happens? I told you that when another block that is invalid, this is actually an invalid order block because it was an inducement leg for this order block above. This one is serving as an inducement for this one. So this is not a valid order block. Instead, it was not an inducement. You can see that it didn't even have any inducement level before it. And then price takes it out. Now, when price takes it out like this, what do you anticipate? The price gives you a form of inducement before the mitigation, which in this case, you can see what happened. The price did what? It pulled back, then gave this sort of this, and then broke a structural low before coming back to mitigate that level. This is how you trade levels like this that are not what? That are not valid supply zones, that are not created by valid supply zones. This is how you trade it. You don't go straight up like setting your limits. In cases, if you do something like that, you're most likely, even if it works once or it works twice, it's not something that is sustainable over time. Maybe 2 wins out of 10. Having a 20% win rate is not something you want to gamble on in this type of trading market. Because how many of you can sustain 8 losses on a row? It's something to be concerned about now. So just do it the right way. And when I talked about this is also like a reclaim block for continuation, by the way. If you look at something like this now, I told you that when it comes to reclaim blocks for continuation, it must be for you to talk about reclaim blocks for continuation, it must be that price has what mitigated a valid demand zone. All right, something like this now, right? You have something like this at this level, and then you have a demand zone here that you're looking to buy from. And this is a valid demand zone. And for price to mitigate this valid demand zone, it has to what? It has to take out this particular reclaim block, right? He has to take out this particular reclaim block and mitigate this level. Now, you know that the mitigation of this level broke this particular leg without creating an inducement or anything. It broke this particular inducement leg. And this particular inducement leg is what? Is not a valid order block to buy from, right? So when you want to trade levels like this, what do you want to do? You wait for price to do what? To give you what? A structural liquidity or any form of liquidity, and then you want trade continuations. Now, there is an exception to this thing. I didn't want to get you guys overwhelmed, and that is why I've been taking it like one by one when it comes to classes. This is two break of structures. In cases whereby your market structure is like this, right? Your market structure is like this, and then price takes out this one, and gives you what? A reclaim block. you can actually trade this particular reclaim block without an inducement. Because in this case now, he had what? He had an initial inducement leg that was taken off. I think this happened on AUD USD some time back. If you guys remember the AUD and USD analysis that we had, the very first reclaim block before the second one, something like this happened on it, whereby price gives you, if you look at this happen, this was the first break of structure, second break of structure, third break of structure. So my point is now that if your inducement level, you know that this level here now, let me call this A, call this B, and call this C. Now you can see that this level C is acting as an inducement for level B. But level B is not a valid demand zone to buy from, right? Probably because this level A is the one that has the sweep, and then there's probably an inducement, an imbalance level below here that price has to play and all of that, right? And then price takes out level B to mitigate level A, right? So what I'm saying is that in cases like this now, you can use level B as what? As a continuation. Price mitigates level B and what? Continues just like this. But if it was two break of structures, just like this, whereby this level A now and level B, there's no level C, meaning that there was no inducement for level B. Level B was just the most recent break of structure. I'm saying that if price you take out B to mitigate A, you need what? A form of inducement, right? You need a form of inducement before using B as a reclaim block. And that was what happened here as well. You had what? We had a sweep at this level. We had this particular supply level. Price did what? Price broke structure at this point. You can see there was a gap here. Price broke structure at this point. So we have like this and then pulled back to create this inducement level like this, right? And then what I'm trying to say now before what? Before the mitigation. This is going to be very different if it was like three break of structures before the pullback to mitigate. Now, if it was three break of structures before the pullback to mitigate, let's say something like this: 1, 2, 3, right? Something just like this is going to be what? This type of mitigation, which is this mitigation 2, right? Which means that if you're using the reclaim block as inducement, you may not necessarily need what inducement level. If it creates, fine. If it doesn't, fine. But for this one now, it was just two break of structures before what the pullback to supply. So this is what mitigation 1. So my point of view here now is that for mitigation 1, if you're ever looking for reclaim blocks as continuations, you must need what? A form of inducement. You can see that after price did this now, what happened? This was the inducement level for this type A setup. And then mapping out that inducement level, what do you need? You need price to give you can see that after price mitigated the supply zone, it sold down. So you need price to give you what? An inducement leg just like this one before coming back to mitigate that reclaim block, right? So reclaim blocks for continuation can be like this or can be what? Like this. Either three break of structures before they pull back to the other block or two break of structures before they pull back to the other block. Either way, one must use what? An inducement level before the reclamation block, or one can just be what? A pure continuation without any inducement. Either way, it is being determined by what? Whether it is two break of structures or three break of structures. So this is the emphasis I wanted to make. The person that sent that particular chart back up, I can't remember exactly, but then I hope you correct that. All right. And then one of the most important thing I wanted to talk about again is this. Whenever you're done mapping your setup, I think a lot of you are having issues with the whole premium and the discounting. Now, this is like, let me take this off. Now, this is the 1 hour time frame for this particular chart, which is what? GBP CHF. If you should go to the 4 hours time frame of this chart, this is the 4 hours time frame of this chart. All right. Now, the first thing you do when you get into the market is to check what price is doing. On the 4 hours time frame now, this is a very bearish pair, right? There was no mitigation to any demand zone at the moment. I think up until when price came, even when price came to this level, let me see. Okay, price swept this level here. So at the moment, there's no mitigation to any demand zone yet. This was bearish, where you had price take out the previous higher low, right? And after taking out the previous higher low, what does it do? It went ahead to give you what another break of structure, showing you that what this is bearish. And then you go to the 1 hour time frame. After establishing that okay, the 4 hours time frame is what bearish, you can see the whole sell move to the downside. The next thing you do on the 1 hour time frame is try to recognize these entry models, right? Try to recognize these your setups. All right. If you go to something like this now, you can realize that what happened. Here you have what your type A type of entry. Now, when you get this type A type of entry now, the first thing you do is what you let me cut this price off. When price when you have this type of entry now, okay, price has closed what below your giving you your typical what type A entry, just like this. You'd want to go back to the 4 hours time frame to see okay, this is what price is doing on the 4 hours. Let's see. On the 4 hours time frame now, you can see that this whole thing is what entirely bullish and it aligns with a 4 hours breaker block because this is a demand zone on the 4 hours that price is validated. Now this gives you extra confirmation for your setup, right? This is the 4 hours breaker block that price failed. A demand zone that was taken out, a valid demand zone. Failure of a valid demand zone creates what? Um, Failure of a valid demand zone like this creates a breaker block opportunity, right? And then you can see that on the 4 hours, price was reacting from what? Price was reacting from this supply zone. These are extra confirmations for your chart. When you have your what the 1 hour, you go to the 4 hours to make sure that anything you're doing is in line with what the 4 hours is doing as well. You want to be on the right side of the market. You want to be on the right side of the market no matter what. If you look at this now on the 4 hours, you realize that this has been creating what chains, other flow chains. All right. If you see what was happening here, price was reacting from what this particular supply zone. Now, this particular supply zone created this next one now as a continuation. This was the first supply zone the price was reacting from. Took out this low, gave like an extra BOS, took out this low first of all, then gave what this particular low, meaning that what this is bearish. And so you've got a continuation now on this particular leg. The next thing you do is to take out your this is the swing high to the swing low. You take out from your swing high to your swing low to see okay what I'm doing is it in the right side of the trend? In cases like this now, whereby price is overall bearish on the 4 hours time frame, because I think somebody asked this question. If you see something like this, price is bearish on the 4 hours, and then your setup falls in the discount price of leg, right? Is it safe to continue with your entry model? Now, in a setting like this is safe to do. You know why? Because this is bearish on the 4 hours, meaning that price is what's going to be targeting to take out this particular low. So that's why I told you your most important focus is what where price is coming from and where price is going to. In this case, now you've established that okay, price is reacting from this what 4 hours supply. This is a continuation of that 4 hour supply. So this is where the initial move is what's coming from. You can see that there was a mitigation to this supply zone, and that is why this demand level did not hold. Price was unable to take out this particular external high. So for now, what we're still bearish. All right. It's only in cases whereby let me say the 4 hours is buying, and then you're trying to catch a sell on the 1 hour. That's when you start checking the premium or discounts. But if it's the same trend, then you can still go ahead. You're very much safe. All right. Now, in cases like this, now if you look at what happens when you're done, you see where price is coming from, and then you can see that okay, this particular setup aligns with what? It aligns with the 4 hours breaker block as well. Right? You can see that price took out this particular demand zone without any reaction to it, which creates what? Your breaker block. I mean this particular demand at this level. And then you go back to your 1 hour, you don't you can see the way I did all of this analysis. Your price is coming from the price is going to on the 1 hour time frame, 4 hours time frame. Now when it comes to targets, sorry, let me go back to the 4 hours time frame. Where price is going to can be a very good target leg for you or target level. Knowing where price is going to, okay, maybe you target the external low if price is going to the lower low, or if you're not greedy enough, you can just do what your risk to reward ratio. For most of you, I already know what risk to reward ratio is. For most of you, that would be using a constant risk to reward ratio of 1:5, fine. 1:3, fine. But then your risk to reward ratio is going to be subjective. I can't tell you that this is a must. There is a must to use what this particular risk to reward ratio or anything, because it's you when you're executing, you find out that okay, you realize that okay, whenever price gets to 1:4, my setup it starts retracing. It means that that point at which you're sure that you've been overly and multiple times you've been able to recreate, right? Those are the points whereby you use as your static risk to reward ratio. So if you've consistently targeted 1:5 and it has worked for you consistently, that becomes what your risk to reward ratio. If you think that you've done 1:10 many times, the overall take profit target is like 1:8, and then you see that at 1:5, price starts retracing, and then you're not like let's say psychologically strong enough to maintain or take in those retracements, then you can be targeting with those 1:5, those internal highs and internal lows or whatever, right? But then in this case now, you see that we are what in a downtrend. So this is a low that you can target because it is a lower low. This particular low here now, it is what a targeted low. Remember that the lows in a downtrend are what targeted. So you can say to extend your target to this, you can set to what leave your target at this level, or instead you can leave your target at what this week low. Anything you want to do depends on what you've consistently practiced and works for you, right? I already told you what to target. You target lows and highs, which is the targeted lows and highs. Highs in an uptrend, lows in a downtrend. You target areas of liquidity. You target what areas of inducements. These are the three most important areas that you target, whether internally or externally. These are the 3 points at which you target. Your target should know what be random. Now you've been able to establish all of this on the 4 hours time frame. And what's the next thing you do? And what's the next thing you do? You go back to what? You go back to the 1 hour time frame to now properly map out what your setup. Since your setup is in line with what price is doing on the 4 hours time frame, right? So I'm going to take this off and take this off. All right. Now you see this is your setup. Now playing price, you can see what happens. The price comes. Okay. Now price comes, mitigates the setup. You can see the mitigation of the setup in this case. Mitigates the setup with a very sharp move. What happens? Sells down to the downside, right? Your take profit target hit. If you were targeting the external low as well, I think this particular move should have taken price to the external low. Now, at points like this now, your setup was mitigated and went straight to take profit targets, right? If you want to take a re-entry on that setup, this is where you now start looking for what the reclaim blocks as your continuations, which I already told you that in cases like this, whereby the inducements did not have what a form of inducement before the mitigation on the initial order block, you now look out for what structural or a form of liquidity or a form of inducement before the entry, and then what you place your entry and execute. This is what two trades, the same trend, right? This is two trades, the same trend. You can see that everything you're doing is what aligned with what price is doing on the 4 hours time frame. Even if you didn't catch this on the 1 hour, and you're able to recognize that breaker as continuation on the 4 hours, you can still trade that on the 4 hours time frame. For something just like this, anything you're doing should be in line with what price is doing on the 4 hours time frame. But I see most of you ask, oh, I don't know how to align premium and discount. I don't know how to align premium and discount, right? Just make sure that whatever you're doing here is aligning with what price is doing what on the 4 hours. That is the most important part. That you're right with your structure. All right, that you're right with your structure. You need to just be in line with what price is doing. Whether you get every other thing right, the moment you get this wrong, your entry patterns become useless. Imagine buying in a market like this that is selling aggressively. Whether you got or you recognized your entry patterns correctly, this is now useless, right? So anything you're doing must be what's in line with what price is doing on the higher time frames, which is what on the 4 hours time frame most especially. Since you're all what day traders, anything you're doing must be in line with what price is doing what on the higher time frame. Now, again, I think another thing I wrote down that somebody talked about as a concern is the mitigation blocks. Now, your mitigation blocks, I already told you that they must not be what traded without inducements. You already understand that mitigation blocks are created by what? They are created by the impulsive breaks of price to probably a higher high, just like this one, or in another case like this, impulsive break towards sorry, let me take this a bit up. Impulsive break to a lower low, just like this one. Now the difference between the mitigation block and the breaker block, like I previously mentioned, is that what the mitigation block continues the trend, the breaker block what opposes the trend. Remember that in breaker blocks you're looking out for what? You're looking out for like bullish breaker block, a bullish order block, failure of a bullish order block is what the bearish breaker block. But then these mitigation blocks continue the trend, just like something like this now. Price did not become bullish, instead what it continued to the downside. In this case now, price did not become bearish. If not, it did not continue to the upside. This is what the mitigation blocks look like. But then this is your schematic diagram for your mitigation block. There should be a form of inducement before your mitigation block is valid to buy from. Instead, if there isn't, right, then start looking at the order block or the weekend block opportunity. This is how you should trade it, something just like this, right? Now, the mitigation blocks, you hardly see them form. I think most of the times they form on the higher, I told you before that they form on the very higher time frame. So very hardly will you see them like on the 1 hour, just like that, just once in a while. I think I saw one on gold like was it last week or last 2 weeks? When we started our entries class, there was one mitigation block on gold that particular week, right? But then your mitigation block should look just like this. There should be a form of inducement before price mitigates that mitigation block. May not necessarily break structure. It could be something just like this, something just engineered. Let's say something like this, right? And then price mitigates and sells. But there should be a form of inducement mitigation block. If not, that mitigation block can be taken out and then price what comes from the for the other block below or something just below, right? But then it must be what just like this. So you're not trading your mitigation blocks randomly. Even this mitigation block, I told you that they are the same thing that people that trade on key levels. It's the same thing they call the A-shaped key level, V-shaped key level. And you understand that they don't trade it without what a form of inducement. So it's the same thing here. Just that you're not calling them key levels, you're calling them what mitigation blocks. You need to see like a form of inducement before them. All right. And then the next thing that someone talked about was correlation. Now correlation is usually done in relation to dollar index, which is the DXY. All right, this is dollar index DXY. Now correlation is usually done with in relation to a DXY, which is the dollar index. Most of these pairs that you see, like the pairs that have USD as their currency, as their base currency, or USD as their quote currency, you already understand what USD as base currency is and USD as quote currency is. It means that for base currency, it means that USD is what the first currency, like USD JPY, USD CAD, USD CHF. They are the ones that have USD as their base currency. Why the ones that have USD as their quote currency is like the JP USD, EUR USD, NZD USD, and the rest of it. Right? Those are the ones that have USD as the second currency. Now, this correlation is simply a measure to how these currencies are related, like how they tend to change together. Right? The first thing is that I already told you that DSY, which is their major measure, that's major measure, just like this, is the DXY. It's just dollar index, right? Now pairs that have USD as their base currency, which is as their first currency, right? Like the EUR USD, right? The sorry, as a first currency, that's base currency, like the USD JPY, the AU, and what else again? What else again? First currency. Okay, USD CHF is there as well. We have USD CAD. All right, pairs like this that have USD as their first currency or their base currency, they are what? They are positively correlated to DXY. Positively correlated means that they are the same. They are going what in the same direction. If this DXY, if you come to DXY to analyze it, and you see that DXY is pumping, these pairs that have USD as their first currency, most of the times they are what pumping as well. Just like this now, you can see what this is DXY on the 1 hour time frame. So if DXY is moving to the upside, it is anticipated that if you go to let's use one pair. Okay, I don't think I have any here. Let me add something. Let me add USD CAD. All right, it is anticipated that if you go to a pair like this, which is the USD card, you're seeing what the same thing, just like this. All right. So if DXY is pumping, these pairs that have USD as their first currency are positively correlated to it, which means that as it's pumping, they are pumping as well. All right. Let's go back to DXY. You notice that they have what very similar what structures, which means that as DXY is what dumping, if DXY is failing, they're also what failing as well. So if DXY is moving to the downside, they're moving to the downside. That's why sometimes you notice what you can notice like your type A or type B type of entry, and then when you come here, you're seeing what the same thing as them. These pairs that have USD as their first currency, they are positively what's correlated to dollar index. That's why most of the times you see what the same structure. Like here now, you can see what that DXY is what very bearish. All right, you can see that DXY is what bearish. If you go to such pairs like the USD JPY or the USD what CAD, sorry, let me just okay, USD CAD, something just like this. If you go to okay, if you go to USD CAD, you'd find out that what it is very what similar structure. This is what bearish as well. All right, this is bearish as well, almost the same thing that the DXY is doing, and that's the same thing that will be happening what on USD CHF, just like that. So these pairs that have USD as their first currency, they are what positively tied to DXY. When you analyze DXY, you see that DXY is what bearish. 80% of times, this is up to 80% right. You would realize that what this is also what bearish. When DXY is bullish, they are what also bullish. So they are positively tied to DXY. Where DXY move is where they move. But then the pairs that have USD as their second currency or as their quote currency, let's say GBP USD or AUD USD or okay, NZD USD is there as well. AUR USD, you know, all these pairs that have USD as their second pair, they are what's negatively correlated to DXY. Negatively. This means that wherever DXY is moving, they are moving in the opposite direction. Which means that if DXY is or even XAU USD self, which means that if DXY is pumping, they are what? Dumping. If DXY is dumping, they are what? Pumping. They are negatively correlated to DXY. GBP USD, AUD USD, NZD USD, all these ones that have USD as their quote currency. Like if you look at let's look at AUD USD now. All right. You can see that AUD USD. Okay, sorry, I think my brother has a markup there. Let me not stop that. Let's look at okay, there's XAU USD here now. All right. Let's look at XAU USD. You can see that DXY was what dumping, but you can see on XAU USD 1 hour we have what a bullish structure. And even if we decide to add what let's add EUR USD, okay, you would realize that what it is also bullish, because what it is negatively, what's happening to this, because it is negatively what correlated to DXY. So when DXY is dumping, they are what buying. You can see that looks like just the inverse of what is happening what on DXY. All right, something just like this. This looks like the inverse of what is happening on DXY. You can see that it is what bullish, DXY is what bearish. So these pairs that have USD as their base currency, they are what, they are positively correlated. DXY pumping, they are pumping. The pairs that have USD as their quote currency, which is the second currency, they are what negatively correlated. As USD, as DXY is pumping, they are dumping. As DXY is dumping, they are what pumping. So that's it about correlation. And also, I want to also contribute about correlation on JPY pairs, right? Something just like this, or CHF pairs. Now, this is true to a very good extent, but may not always be the case. I told you, for the major correlation on DXY and USD pairs, that is settled positively and negatively to a very, very good extent. Except on, let me say, very, very severe news days. That is probably when something like that may not be correlated. But correlation is good to a very good extent. It can help to like add to your analysis, where you don't analyze and check, okay, this thing I'm doing, was it in correlation to was it doing in correlation to what, to the XY? They can give you what, an extra confidence. But then what I want to mention is this: for the JPY pairs, when when USD JPY is doing something, there are high chances that CHF JPY can be doing the same thing. Pairs that have the same quotes, when it comes to JPY and CHF, they usually have what, the same structure. Let's look at EUR JPY and CAD JPY now. These are the two here. Okay. I also have AUD JPY. So if you look at AUD JPY now, we have, you can see this. This is what is happening on what, AUD JPY. Now, if you go to CAD JPY, it is almost what's like the same thing. Let me take this off. It is almost like what, almost the same thing too. You see this thing happening here. That was the same thing what's going on here as well on the AUD JPY, right? Something just like this. And if you go to the EUR JPY, it's still what, very similar thing happening on the EUR JPY. So most of the times you see these pairs like the JPY, the CHF, they usually have what, the same correlation, in the sense that what is happening currently on AUD JPY may have just happened on CAD JPY, or will happen on CAD JPY. Most of the times their structures are usually aligned. That is why you can have a setup on GBP, on CAD JPY, and you go to AUD JPY, it's what, another clear setup, very, very similar. So their structures are slightly like most of the times. This is not like to 100%. Sometimes it can be different, right? But then to a very good extent, most of the times these pairs that have the same quotes, like JPY or CHF, they usually have what, similar structures, similar structure interpretation. All right. So but then the most important one that I want you to know when it comes to correlation is the positive and positive and negative correlation to what, DXY. This is DXY, which is what, the measure of dollar currency, dollar index, right? So it pairs with the first correlation, the first currency as USD are what, positively correlated. Pairs with the second currency as USD are what, negatively correlated. And then the next one that I have here that someone talked about or asked about is the, I'm so sorry, it's almost 10, but then I'll soon be done, is the demand and supply zones. Someone said not all demand and supply zones are being created by engulfings. So how do we map them out? Now, here's the thing. Majority of the supply zones you see, definitely will be created by what engulfings. But in cases where they are not, let's say we have something just like this now, a week like this. Okay, this week is still an engulfing. All right, for something just like this now that may not necessarily be what this is not an engulfing candlestick, and you want to map out a demand zone from this level, you can map out from this particular candle. You just need a proper candle in that zone that is what clearly going to act as your order block, just like this. All right, you can use a candle like this in this case. In cases whereby you have weeks, like long weeks, right? If it's too long, you can decide to do what 50% of the week. I'm trying to look for a very good example of what I'm trying to illustrate. Um, okay, this is an engulfing, by the way. You can map out using the entire candlestick, just like this. You can use something just like this. But in cases whereby I'm not seeing a good example of what I want to show you, but when I do, I'll probably talk about it in that class. Maybe one of these days I'm scrolling through and I see another block that was not formed by an engulfing. Majority of the times though, other blocks that you'd encounter would definitely be engulfings. But when they are not engulfings, you can map them out using that last candlestick. But in cases whereby they are very long weeks, right, you can decide to do 50% of the entire candlestick like this now. Let's say this was a valid order block. You can do 50% of what the entire candlestick, marking this out. Don't worry, subsequent classes, even if it's on synthetics, when I see proper example of other blocks that are not engulfings, maybe in rare cases like that, or if somebody sends it to the trade idea groups, I will use it as an example and drop it on the announcement group to lay emphasis on it, right? So these are the things I wanted to talk about in this class: the risk to reward ratio, the mitigation blocks, we claim those as continuations, entry models, correlation, and the mapping our demand and supply zones. Now, what I want you guys to do is to continue as you have done currently. Especially, I would like to say that I'm impressed with what is going on so far. Most of you may not, let's say, you're not perfect yet, all right, but then you're getting the concept little by little, which means that you need to put in more effort, more practice to be able to get this thing properly. All right, we're trying, but then it can always be better. And what I want you to do is to go through what your colleagues are doing. That is the most beautiful and amazing part about group mentorships. You get to learn from other people. Look at what people are doing on the winning setup. It does not even necessarily have to be, just look at how they mapped out. And then you go to those pairs that they mapped out and see if you would have been able to recognize that, right? You learn from what people do. Even for my private students, you would realize that everybody at last, by the way, they are private. Everybody at last are private. But then I combine them in a group, right? So that they can see what other people are doing. If Jessica is not dropping, Nelson is dropping. Nelson is not dropping, Timothy, like one person, two people, two people. You get to learn from your mates. All right. So this is not something that you would do alone. This particular trading journey, you have people to do it with. This is where you make friends. This is where you get your trading partners and all of that. So when people drop things on the winning setup group, go through it. Go back to your charts. Study what they've done. What worked for other people. Try to see, okay, what didn't I get right? If I was one that mapped this out, what would I have done? No, there was somebody on the chat and discussion group, I guess, that sent or that sent a setup that one other person sent to the group. And I was like, oh, on the trade idea, sorry. I was like, this particular setup was not in the premium mode. Why are you trying to sell for me? That is how you learn. Look at what people are dropping and try to see what are they seeing that I'm not seeing, or what are they not seeing that I'm seeing that I think they should see. These communications with your mate and all of this is how you learn. This is how you emphasize to your brain. And when these emphases are laid, that is how you recognize these things. All right. So I need you to go back to your chat again, just like you're doing, but this time with more intensity. Whether you're forward testing, whether you're back testing, anything, but go back. Try to study these patterns. Try to recognize it because there's some setups that most of you are saying that even me, I don't recognize. I keep asking. I think I asked somebody. I said, "Where did you learn this from? Let me know if I'm the problem." Do you understand? So when you're done mapping out your setup, I want you to look at it and ask yourself, does it align with type A or does it align with what type B? Look at it. If you look at most of the one that people are dropping on the winning setup group, you would see that clearly you'll be able to tell if they are what type A or type B. People should also be able to tell yours, interpret your own if it's what type A or type B. So you don't analyzing before you send it to ask, oh, Stan, is this correct? Only is this correct or Star is this correct? When you're done tagging, right? Before you send it to ask yourself, is this type A or is this type B? You should be able to recognize a pattern on your setup before you see that this is tradable. You should be able to validate it. So if you just go to anywhere, whether it's the sky or anything, and then just map out something and then you ask, oh, is this valid? You just go anywhere, anything, and then just drop it. Is this a valid supply? Why did this fail and all of this? Right? It should be something that you validated. That is why your validations were dropped. I told you if you want to add your validations on the bottom mark on your chart, if you want to write it down on your journal or anything, you're free to. But then they must be used. That is why they are there for you to be able to validate these zones. This sweep must be what's very evident. Your sweep should be evident. A level that sweeps should be what the significant level. This sweep should be shown. All right. So when you look out for these type A's and type B's, you validate them on the 4 hours without premium or discount. And that is it. That is how you go before you send them. Recognize what a pattern. Before you send them, recognize what a pattern. All right. So go back again to you. Today is Friday, so I think the market has closed already. Okay, tomorrow is Friday, so there's still one trading day again to look out for these things. All right. So tomorrow again, you continue with what the market has given to see type A or type B. All right. So that brings us to the end of today's class. The recording is going to be made available. Please, please, please. I'm emphasizing on studying. All right, I'm still emphasizing on studying. It is very important. I need to make sure that there's a progression before I move into stacking at specific points on synthetics. All right. So I need to make sure that as I'm moving, you guys are moving as well. Not like I'm leaving you behind and then I'm moving to the next one. All right. So the recording is going to be sent to the group, and then if you have any questions as well, as usual, I'll drop them on the group, and I'm going to make sure I go through them. Um, Take care of yourself.